Hey everybody, welcome back. This is day 11 of our 15-day personal finance overhaul program. All right, let's get started. We got a lot to talk about today. So yesterday and the day before, we took some great steps. We said, okay, it's time to start investing for retirement, and we can invest in those retirement monies through a traditional tax deferred plan or a Roth plan where we pay no taxes when we turn to retirement years and start making our withdrawal. Or as for today's conversation, we can now lump in a third bucket, which is what if I want to invest outside of my retirement plan, right? So you can invest for retirement and your money gets treated a certain way, or you can invest on your own simply as an investor and your money will be treated a different way. So today, what we're going to do is get started as an investor by learning the investment lingo. When people talk, do you know what the heck they're talking about? So when they talk about the difference between investing and savings, stocks, bonds, mutual funds, ETFs, short-term, long-term capital gains, dividends, dividend reinvestment plans, does any of this stuff mean anything to you? Probably not, because no one's taken the time to teach it to you. So we're going to have that conversation today. Our whole conversation is going to build off of the slide that you're looking at right now. So let's start at the very top. Why do you want to invest, and maybe why not save? Now let's be honest, there's times for saving and investing. But what is the difference? Investment is when your money grows by making more money for you. Saving is when your money is simply protected. You're protecting your principal. Put $100,000 in a bank account, you will always have $100,000. You've protected your savings. But you are going to grow your money, put your money to work for you through investments. I'm going to start with 100,000. I hope that I end up with more than 100,000, right? That's investing. Now, why do you want to do this stuff? And the answer is, quite surprisingly, that not all money gets treated the same way. If you have a paycheck, congratulations, thank God you have a job. Now, the flip side of the coin is, I'm so sorry, but you have some of the worst money in the world, right? Does that make any sense to you? I just said, good thing that you're earning money. The bad thing is you're earning money. You're earning money as what's called earned income, a paycheck. You are paying the highest tax rates possible, and your employer is taking the taxes out before you even get the check in your hand and already sending your money off to the government before your paycheck can be cashed at the bank. You get a check for what's left over after the government takes their share. The other thing that's terrible about a paycheck, and everyone knows this, but maybe they've never explained it to you in these terms, you have so little control over earning more money. Go into your boss's office tomorrow and say, I want to earn another $10,000 a year. And when he or she is done laughing at you, they'll tell you to get back to work, right? You have so little control over your income, and you have so little control over the taxes that you pay, that a paycheck is one of the singular worst things that you can do. It's literally one step above not having a paycheck, right? But if you're not making money through a paycheck, how else should you / could you be earning money? What are you doing that's keeping you from being rich? And the answer is you're not doing what rich people do. Rich people don't earn their money by having a job. They earn their money through investing. And investment money is treated differently than earned income money. Now that is for a very clear reason. Just like your employer match, just like the tax benefits of a 401k retirement account or a Roth, where you can grow your money for retirement and not pay taxes on it or defer your taxes on it, with investments, you still have the government offering incentives, creating basically social engineering. They want you to do certain things for the good of all society. And they do that through the tax code. Investment dollars are taxed less than earned income. Here's a picture of Warren Buffett, the fourth richest man in the world, who set the world on fire when he said something that was well known for decades, but he actually said it out loud, and the people who didn't understand what I just said to you grew outraged. He said, I pay a lower tax rate than my secretary. Now, he didn't say he pays less taxes. He pays taxes at a much lower rate. His secretary is earning a paycheck, earned income. She's probably paying 28% or higher in her taxes. Warren Buffett, if he is making his money off of long-term capital gains, he bought something, he sold it for a profit, that's called a capital gain. If he held that investment for more than a year, he paid no more than 20% interest on that money, whereas his secretary paid 28%, maybe higher, plus state taxes, plus other taxes, right? But Warren Buffett paid 20%. So you can pay a lower tax rate on investment money over earned income money. And that's really what we need to understand. Act like an investor. If your politics has you at odds with this concept that somehow you hate the rich people, you need to just put that off to the side. This is a conversation about how the system works, right? If you want to be rich, you have to act like rich people. Rich people do not save their money. Rich people do not earn paychecks. Rich people are investing. And the government wants you to do that because that stabilizes our economy. The longer you let your money sit in an investment, aka a long-term capital gain, the more stable the funding supply is for businesses who are looking to expand and hire new people and create more shipping lanes and build more buildings, update their production lines, etc. As John F. Kennedy said, a rising tide lifts all boats. We want a strong economy. The economy is made up by we the people, not just we the people, the workers, but mostly we the people, the investors and the business owners. So you need to get into that little circle of investors so that you too can become financially successful. All right. So there's a long drawn out explanation about investing and why you want to do it, not only for the economy, but for lower taxes. How you get rewarded by the government for supporting our economy. The rest of the other stuff is just vocabulary words. Stocks, bonds, mutual funds, etc. Let's talk about all those things one at a time. So what is a stock? When a company wants to raise money, typically to expand or maybe upgrade their production lines, they will issue shares of stock. They will offer ownership, partial ownership in their company if you will give them some money. So how much ownership you have in the company is tied to how many shares of stock you purchase. So you become an owner in a company that issues stock. Stock equals ownership. As the company does well, the value of your investment does well. If the company does poorly, the value of your investment does poorly. And you can always buy and sell your ownership with other people. Hey, that is the stock market. That's what happens every day up on Wall Street. People are buying and selling because somebody thinks that it's time to get out, and some people think it's time to get in, and they agree on a price. And that is exactly what's happening on the stock market every single day. Buying and selling ownership in different companies. The other term you may hear a lot is a bond. You see stocks and bonds, stocks and bonds. Well, what is a bond? A bond is not ownership. It is a loan. In this particular example, I'm showing you a Series EE savings bond from the government. You loan your money to the government, and they take your money with the promise that they will pay you a certain amount of interest And after a certain amount of time, they will have paid you a certain amount of interest in return. That is called the maturity date. Your bond will mature. In this particular picture, it's a $50 savings bond. You will purchase that savings bond for $25. A million years from now, because the interest rate is so terrible, it will take you a long time to double your money at 1% interest or less for you to gain back the 25 you lent and the 25 that they promise you to make that a $50 savings bond, right? But people do it. You buy and sell bonds. They trade them amongst themselves the same way they trade back and forth stocks. But a stock is ownership, a bond is a loan. The longer you hold it, the more interest rates you get, or the more interest you earn. But today, it's very low rates. But you can buy a bond not only for the government, but for different businesses as well. If you want to loan money to a business that's not willing to sell stock, they have bonds for that. But as an investor, this is where you're going to spend all your time. This is called a mutual fund or an exchange traded fund. What this is if you can't afford to buy 5 or 6 different kinds of stock, different companies of stock to diversify your portfolio, you may feel like there's no option for you to invest. That's simply not true. There are hundreds and hundreds, I actually ought to say thousands. There are thousands upon thousands of mutual funds, and now something that's been created called an exchange traded fund, very similar to a mutual fund. They typically have less fees because they're not marketed and they're not managed as tightly as a mutual fund. So what happens is you see the guy off there on the right hand side, you have a professional fund manager who is buying and selling stocks. That's his job. He watches the market, not you. He buys and sells stocks when he thinks they're right, not you. And he buys and sells with a mutual collection of money from everyone who's interested in letting him be their fund manager. He takes everybody's money and he buys a whole bunch of stocks. And his fund, just like we had that traditional bucket, we had that Roth IRA bucket. Now there's a third bucket called a mutual fund or an ETF. And you can put all kinds of different stocks in that bucket. That bucket has its own stock symbol, a singular symbol. And you can buy shares in XYZ mutual fund or XYZ ETF. And that one stock symbol you can track on the market. And that stock symbol represents all the diverse holdings that your professional fund manager is buying and selling on a daily basis. So this is a great way for you to get a couple of things. First of all, you're starting to get partial ownership in companies that you otherwise could not afford if you were buying stock outright. There are some companies out there, the stock is thousands of dollars a share. Unless you have thousands and thousands of dollars to invest, right now, right here, money in your hand, you can't diversify. You are simply buying a singular stock. We'll talk about the dangers of that soon. But you can invest in multiple companies and get professional management, and you can buy in fractional shares as your budget allows. So you could become an owner in all of these companies by buying them through a fund. So now let's talk about capital gains and losses. So when you buy or sell a stock, that price will compare to what you bought it for versus what you sold it for. If you sell it for more money than you bought it for, you have a capital gain. If you sold in an investment for less than you bought it for, you have a capital loss. The interesting thing about losses, remember, I keep telling you, the government wants you to do this. The tax laws encourage you to do this. If you sell investments at a loss, you can use those losses to offset gains in other places or in your adjustable gross income. If you lost so much money that you exceed what was allowed to be written off in any one year, you're actually allowed to carry those losses forward to the next 2, 3, 4, 5 years, always writing off the loss. You're always going to make it back to zero, right? So theoretically, there is no such thing as losing money when you're an investor. Even if you take a loss, the government will help you recover that loss because they want you to be a player in the game, right? The more people who are investing, the more solid our economy, the more solid the economy, the better for everybody. Do you get the theme yet? Do you understand where you fit into the program yet? You need to become an investor. The government makes it very attractive. Your dividends, your gains will be taxed differently than your income. So if you have gained money and you held that investment for less than a year, they're just going to tax it at your regular rate of income, which we just said previously, some of the worst tax rates on the market, right? Your paycheck is the worst taxed thing that exists. But if you start holding those investments longer, as you see here on the screen in green, is where, depending where your income level is, your long-term capital gains can start to be zero tax, maybe 15% tax. And if you're really part of the affluent, where your annual income is 400 and almost 470,000 a year, you're only going to pay tax rates at about 20%, which is still almost a full third lower than people who are earning a paycheck. Do you get it yet? Let's keep working on this. This is great stuff. Dividends. All right, let me show you something here. Not all stocks grow in value, but all companies that issue stocks want to keep their stockholders happy. Okay? Everything in the United States is built around the quarter, the financial quarter of the year. They have to answer to their stockholders. They have stockholder meetings, and stockholders are like, what are you going to do to make the value of my investment in your company go up? That's all people want. They want to make more money, which is cool. So there are times when companies grow in the value of their stocks, but there's times when their stocks are relatively stable. The price of McDonald's, for example, in this graph is pretty much 200 bucks. And it's been 200 bucks for pretty much an entire year. So how does McDonald's get you to remain a good investor and want to own their stock? Because if everybody sold their stock, you'd think that the company's worthless and they would suffer a financial hit because they have to pay back. Eventually, somebody's got to buy that stock back. So how does a company that's relatively flat on growth get you to do these things? By offering dividends. Dividends are like the interest that you'd earn in a bank, right? So the bottom left corner here, I did a search on the internet and said, hey, show me the best savings accounts for today, which I'm making this video in December of 2020. You will see that the very best savings account pays 0.6%, not 6%, 0.6%. Okay, and the ones below it are 0.55 and even 0.5%. Now take a look at what McDonald's, as an example, right? These are examples. I'm not telling you to buy McDonald's stock. All individual purchases, recommendations got to come through a professional licensed financial planner. McDonald's, as an example, is a company that offers dividends on their stock. Not all stocks do it, but relatively flat performers always do. They offer 2.49% interest. You get that? Instead of getting 0.6 at the bank, buy stocks in McDonald's. If it goes up in value, you make out, but you will also make 2.49%, almost 250% more interest than you would get at the bank. That's powerful stuff. So even as an investor, you can be thinking about savings and earning income. Okay, so every year, companies that pay dividends will pay out their dividend to their investors, and you'll have a choice. Do I want my dividend as a check, which is, depends on how much money you've got in there. And then the other option is that you can reinvest those dividends. Dividends reinvestment plan, or a DRIP, right? They take the letters. Dividend reinvestment plan is a DRIP. And you can have them continually take the dividends that they were going to pay you and simply buy more shares of stock. And now you're getting more stock shares. You continue to get the dividend every year. That number gets bigger. Not only do you earn more shares, but now you're getting interest on a bigger number. It just continues to grow, right? So if you look at the example here, um, just buy one share of McDonald's, and in 29 years you can double your money, right? You earn $5.17. You say, well, $5.17 isn't actually enough to buy a value meal. Go ahead and just buy me more stock. And if you keep doing that, you will start to magnify and snowball your savings and your investments. That 2.49 sure makes a difference. And you can see that over time, your dividends continue to grow. Now look at that center column that says yearly dividend. The more you buy shares of stock, the more dividends you will earn, right? If you own more, you get 2.49% of a bigger number every year. So look how that number grows. And it will continue to grow over time. And if you're doing it, and this was just with buying a single share. Imagine now that you're investing, hundreds or even thousands of dollars at a time as you free up money for investing. You can see how you can be on this upward trajectory of financial growth. All right, then comes this term of diversification, or don't put all your eggs in one basket. If you went out and bought only McDonald's, and America goes on the next diet kick, right? We had Atkins before that. We had, Jazzercise before that. We had Jane Fonda doing her workout. And everybody says, oh, don't eat fast food anymore. Nobody's going to go to McDonald's, and McDonald's stock is going to go down, and you're going to take a loss. And if that's the only thing that you're investing in, you could be in a bad way, especially if you need that money as you're approaching retirement years, or you're going to use that money for a down payment on a house, et cetera, et cetera. So the way that you avoid these things, and again, this echoes back to what we said about these mutual funds. Why do you want to be diversified in a mutual fund? Because you can take a look at utilities. That's why I'm showing you three graphs here. Utilities, healthcare, and energy. And notice that they're not, pick any particular point in time, they're kind of not in sync with each other, right? So through diversification, when one goes down, the others may remain steady, they may even go up. So you're flattening out the really high highs, and you're softening the really low lows, and you're basically moderating your gains. Now, of course, if you had a crystal ball and you said, well, I'll just buy everything that's going to go up in value, well, then you wouldn't need to diversify. But last time I checked, they stopped selling crystal balls in the Sears catalog or even on Amazon, and the ones they sell probably don't work. So you need to have a policy of diversifying and protecting your investment from the crazy ups and the devastating lows, and kind of just mellow it all out a little bit. That's where diversification comes in. And through ETFs or mutual funds, that's an excellent way to get this level of diversification with the limited amount of money that we have to invest, and get the professional management that goes along with it. So mutual funds and ETFs are a great way for us to become investors and not have to come up with all that money at once. We can grow our way into being players of the game. All right. So this was a lot of talking today, but I hope you understand the lingo. More importantly, I hope you understand the theories behind all these different things and why the government wants you to be an investor, why you need to be an investor, right? The American dollar loses value every single day through inflation. You've got to be an investor to stay ahead of the curve. And I hope that this video helps you understand how to invest, or more importantly, how to understand and hold the conversations that you need to have in order to become an investor and understand what's being said to you when you talk to a financial planner. Okay? You don't want to give them that doe in the headlight look. You want to understand the words that are coming out of his mouth, his or her mouth, right? So day number 11, here's your tactic for today. Read, read, read. Go to the library, bring up your Kindle, do whatever they have online, go to 1,000 websites, and just learn more about this stuff, which is what I've done. Read everything you can on any of this stuff. And now that you're starting to get some of the lingo, what you're reading starts to make a little bit more sense. But the library has got a whole section on personal finance books. Some of them are crap, some of them are really interesting. You'd be surprised how many don't agree with each other, which is good because now you have different perspectives and different points of view. Become familiar with these investment terms and concepts. Speak to your financial advisors so that you can understand what they're talking about. And listen, nobody cares more about your money than you. It is of no value to nod along in blind agreement because you're embarrassed to tell your investor, hey, buddy, I don't have a clue what you're saying. Don't be that guy. Your money, so it matters. Your questions matter. Raise your hand and say, hey, I'm following along somewhat, but I need you to explain something else to me so that I fully understand what's happening with my money. Okay? And then the other thing I want you to do is just like I showed you this graph, just go out and, go to your search bar on your browser and just pick a company name and say, McDonald's stock price, uh, another company's stock price, the toys that your kids have to have this Christmas, stock price, and just start looking at the graphs and look how they do over time. See if they're paying any dividends. Get an idea of what different segments of the market are doing, and maybe find some companies that you're interested in talking about buying with your advisor. Okay, get a lay of the land where you're starting to become an investor, and understand that you need to become an investor and the government wants you to become an investor, and you will be rewarded financially, not just through earning money, but by earning money at favorable rates that you could never do simply by working and saving your beans at the end of the month. All right. I know it was a lot to take in. Play around with it, get familiar with it. Let this become a regular action item in your life. Execute now. There will be no change without action on your part. Whew, a lot of talking today. I will see you tomorrow.